value trades, Forex, CFDs, and commodities.
Hello, everybody, and welcome to today's webinar on the topic of leverage. So that's great to have you here. We will have a look at the positives and also the challenges that this topic brings with itself. My name is Malte Kaup, and I'm happy to be the moderator for tonight's webinar on behalf of Value Trades and for Value Trades customers. So thanks that you kind of found a way here to this webinar tonight. As always, if you have any questions and comments, please use the chat functionality. I will do my best to try to respond to them, to address any questions you may have. And as always, kind of a ground rules or a house rules apply that we treat each other in a very friendly and open manner. This has always worked in the past, so that's why I don't really restrict the chat at all. Sometimes it takes a moment until I see a question that is being posted, so bear with me. I will try my best then to go to a chat window to see if you have posted something. But before we get started, obviously it is important, this is a regulated activity, but we also then show you the risk disclaimer. Let me show you, here it is. We can maximize the screen, so make this a bit smaller, and I hope you can see everything. CFDs and FX are leveraged products and carry a high level of risk to your capital. It's possible to lose more than your initial deposit, and you may be required to make further payments. These products may not be suitable for all clients, so please ensure you fully understand risks involved. And obviously, Value Trade is regulated by the FCA, the Financial Conduct Authority in the UK. If you have any questions, please talk to the very competent people based in London and in the other offices, who will be very happy to help you on any questions you may have. So first of all, when we talk about leverage, let me just kind of frame the whole thing by talking a bit about risk management. And that's quite important, I think, to give the topic some boundaries, because a lot of people say, oh, leverage is simply bad, or other people say leverage is amazing, without leverage we can't trade. And I think there's some truth in both, but it probably helps to just have a kind of a bit of a broader view on the topic, and have a bit of a think about, where can it be used in a positive way, and what are the risks and what I need to consider when I trade. So if you kind of step back a little bit for a moment, kind of from a broadest point of view, we start thinking about it in a way of risk management, right? And risk management is the idea that you first of all, you protect your capital, right? When you fund your trading account with your hard-earned money and you put 1,000, 2,000, 5,000, 10,000, whatever the amount is in, you want to make sure that you protect your capital. That's really the starting point. But on the other side, in trading, we deal with a situation of permanent uncertainty. So we make decisions in permanent uncertainty, and we appreciate the fact that there is no reward if I'm not willing to risk something. So on the one hand side, yes, we protect our capital. On the other side, we are also prepared to risk some of that capital in order to generate a profit, right? And before we get into psychology, so that's not the point of today, but please, when you think about trading CFDs, don't just think about that next trade, if it's a winner or loser, but have a point of view where you look at least a batch of trades, like 10, 20, 50, 100 trades, and across the 100 trades, you want to be successful. You want to overall be able to book a profit and not have lost any money. So already, I think I introduced some really important concepts here. One, the notion of risk management and the fact that risk and reward are interlinked, and there's just no way out of that. And that will be quite important when we talk about leverage in more detail in a moment. And secondly, I want to encourage you to kind of move away from that idea that it's all about the next trade. It is not. It is about really flawless execution of your trading strategy across a significant number of trades, significant enough that you can make a judgment on your performance and also get a sense of where you can do things maybe a little bit better. And there are tools out there, and also Velatrade's been really smart to partner up with companies like Chasing Returns, who really can help you to understand how much risk you're putting into an individual trade, how risky is your trading strategy, and on the other side, kind of what do you expect as a reward. Coming back to this slide, so risk management has the two sides, as I mentioned. There's a reward component, but the most important one, and many people forget that, is the component where you start where you start with protecting your capital. The second point that I put here on this chart in the middle is diversification, right? And there is actually a Nobel Prize winner who has introduced the concept of diversification. Again, that also relates to leverage. Diversification is the idea that if I spread my investments and my assets across a large number of asset classes and assets with a different risk profile, that overall will minimize my risk. It will also reduce the absolute return that I can expect from the portfolio, because there will always be some sort of overlap. But another way of looking at diversification's antithesis would be to put all your eggs into one basket, i.e. you pick one currency, you pick one index, and you just put all your money on that index or that currency going up or down. You will not be very lucky with that kind of strategy, especially when we talk about leverage trading, because markets move in both directions, and CFDs enable you to speculate on rising but also on falling prices. So when we have a look at the charts in a moment, you will appreciate that you need to be a bit more agile in the market. We talk about day trading, we talk about swing trading. We typically don't hold trades over weeks, right? That's something you can do in your real stock portfolio, and that's something I'm referring to as the third point here. In your real stock portfolio, there you have the patience to wait for a day, a week, a month, a quarter, a year, 2 years, 5 years, 10 years, maybe even 20 years, to see if a certain company really unfolds its performance. Or when you look at the GBP right now, it's really down, it's depressed. But there are people out there who take a long-term view and who would think that the GBP is going up over the next 10 years, right? Has nothing to do with short-term trading, but it's absolute kind of valid view from a stock portfolio or a currency portfolio point of view. And one notion that maybe is a bit new for most traders is I want to bring that together and show you how you can also use CFDs and the leverage that CFDs bring with them to how they leverage that. Let me just make sure that you see what I'm seeing. All right, so let me see. Why are you not seeing this? So let me just refresh. Sorry, I think GoToMeeting hasn't kind of refreshed the chart, so thanks for pointing that out. What I've just to make sure that you all seen this, so we have the three concentric circles. So the normal portfolio that people have also in their pensions in the middle, when the notion of diversification surrounding that you want to be in different asset classes and so forth, and finally the idea of risk management, that there's a connection between risk and reward, and that can't be broken. So yeah, the point I wanted to make is that I will not only show you the downside of leverage, I will also show you a really massive benefit that you can enjoy by using the leverage that you get with the CFDs. So hopefully that's also a little bit of a different view on the topic, and hopefully I could also kind of whet your appetite a little bit. So just to give you a sense of volatility, and again, we're a bit in kind of a helicopter view right now. I went way back into the markets, and all the way back to 1885 until today, pretty much. and looked at the eras and the times where we had highest market volatility. And we will stay on that slide for a bit, and I will also then introduce the concept of leverage when in a bit more detail. So the point I'm trying to make is that a normal level of volatility is actually something we enjoy over a really long periods of time. And the exception to the rule are these times where we have this excessive market volatility. And you can see a couple of examples here. The biggest spike at the beginning, and a quite sustainable, extensive spike, was the 1929 market crash and the following years. Really difficult time. And we saw excessive volatility in that time. And the next peak of that magnitude was much shorter, but in 2000, dot-com bubble, right? 1987, we have that Asia market crash, and then we have moving forward into the 2000 era. We also know that we had 2008, we had the credit crunch, and what that shows us is that markets, when they collapse, when they sit back, and when they have their downturns, then it becomes really violent, and a lot of people have to realize their losses at some point. A lot of people are getting squeezed out of the market, and that unraveling is really represented by this heightened volatility. And that's now where we build a bridge over to the concept of leverage. That's why in many cases, trading, even with high leverage, works quite well and the market comes back. But there are these situations out there, the complete outliers, where the market has so much volatility that that breaks all the boundaries and all our support and resistance levels that we maybe have drawn even on a weekly or monthly chart. And where you are at risk with a high leverage, because if a market moves against you, your account will be depleted and empty quite quickly, right? So that's the connection I make between managed volatility and leverage. Maybe at this point, just to define the term leverage, it's nothing else than the broker provides you with additional capital when you open a trade. So in other words, when you open a trade, what you have to do, you have to pay spread. And that is with a CFD broker like VeloTrade's very competitive, it's very tight spread, so minimal transaction costs. But you also have to provide some margin. That's nothing else than a deposit or a pledge. You have put some money with the broker to make sure that the broker is willing to do the trade. The broker is also comfortable that he is equivalent capital reserved to cover the trade. And in return, what you get from the broker is leverage. And that can go up to really high levels. It depends on brokers. Some brokers really have ridiculous levels in the thousands, and I can really not recommend that. A reasonable broker goes into the hundreds. That's something a reasonable broker would offer for maybe a currency. And let's have a look at the charts in a moment. For a currency like euro, US dollar, or something like that, where you need some leverage to be able to even benefit from the movements in the market, because without that leverage, you would not be adequately capitalized to even open a trade. So let me show you, let me just go to the chart. Let me just also make sure that you can see it. Yep, that seems to work. Let me show you what I mean by that. So what we have here, let me just move this down a little bit. We have Euro GBP, but let's maybe go to the Euro US dollar 1 hour chart and remove the stochastic indicator. So what you can see, this is a 1 hour chart. You can see that the market has come from this 117 level. We're still in way. From this 117 level all the way down to this 115 level. While this is overall over a couple of days a fairly decent move, right? But when you go in on an intraday basis and you just go back, let's say to yesterday, you see that the markets haven't really moved that much. So from the beginning to the end, the market just had a movement of about 60 pips, if I can see that correctly. So that is not a lot. And we trade here with value trades. We trade 1, 2, 3, 4, 5 digits behind the decimal or the comma, if you want to say that. So that makes it really hard to benefit from this move. While maybe this is still actually a really interesting move in the market, because what you've seen is in the Asia session, we had a move here to the upside, and in the European session, the thing may basically move to the downside, and in the US session, this thing until the end of the day moved more or less to the downside. So that could be also a simple description. But it is quite difficult to imagine that you would be able to capture a trade that really starts at the top and ends at the bottom, right? So that's really unlikely that is going to happen. And with that, it is really important to also be able to use some of the leverage. Again, what is leverage? You put the margin with the broker, and in return, the broker equips you with capital that is big enough to enjoy a trade that has the potential to actually generate some profits. Obviously, it can also go against you. So in real terms, we talk in lots. A lot is 100,000. In example of euro, US dollar, the kind of the second currency is always the one that is important. A lot is 100,000 US dollars in euro US dollar. You either speculate on going up and down, and you probably would not have 100,000 in your account, right? That's the point that I'm trying to make here. So you need the broker to give you some additional capital for the trade to be able to create a strategy and execute a strategy that actually can work in a market that is as tight as the one that we have seen yesterday. And when you look at kind of historic volatility of euro US dollar, it typically stays below 100. So 50 is actually on the lower end of the spectrum, but we have many days with 70, 80, 90 pips. So you need some leverage for this kind of currency. You need some leverage also for indices to be able to execute a useful trading strategy. If the leverage is too low, you will hardly see any market movements or in your account. Or you need to have an account that is just much bigger. You need to have 100, 200, 300, 400,000 in your account to be able to enjoy, the possibility to have a trading strategy that works and has the potential to deliver return on investment. If the leverage is too low, then that is a problem. On the other side, if the leverage is ridiculously high, that is a problem as well, because maybe you're small, I'm just exaggerating maybe a little bit, your small 500 euro, 500 GBP account with a hypothetical leverage of 1,000, 2,000 or 3,000, that will be empty, or you will lose that account very quickly, because there's a fairly high potential that the market moves against us and against you, which is absolutely normal. Out of 10 trades, there are a number of losers. And there's always a risk that these losers are so disproportionate in size that they take away 20, 30, 40, 50% of your capital. And it will be just very hard for you to come back from that. So that's really where leverage can clearly break your trading strategy. Let's just have a look at euro US dollar maybe and see if we can, just for the last couple of days, just make that point on a trading strategy. But and this is hypothetical, this is really, I can't give you any trading advice, right? But we could look at a simple Fibonacci trading strategy where we say we take the high of the day, we take the low of the day, and then just extrapolate that to the next day. And what a lot of traders are looking at is something like this pullback zone between 50 and 61.8. So let me just be very clear what I'm just drawn here. So I hypothesize that this on the left hand side is the day, kind of the current day. What's happening on the right, where I've drawn this green box, that hasn't happened so far. So I've just drawn a standard Fibonacci line from the high of that particular day to the low of that particular day. The day is highlighted by the so-called period separators. You can get them onto your chart, but just going into the options. You can add or remove period separators. I really like them on my chart because they immediately give me an understanding where does a day start and where does where did a day end previously. So I've just drawn a very standard Fibonacci, and a lot of traders will look at the Fibonacci and say, if the market moves back to the 50% of that Fibonacci, I start looking for a move that is in line with the market dynamic of that day. It is in line with that downward movement that we had from the previous day. And a lot of traders will go even further. And again, no trading advice, just hopefully an example that gets a point across. A lot of traders will say if the 50% holds, then we're looking for a target of a 123.6, and the whole thing would be invalidated if we get to something like behind the 78.6. Some people would even play it much tighter and would say if it gets outside of a 61.8, this trade is invalidated. And really the point I want to make is a very simple one. So we have now an example of a successful trade because, believe it or not, the setup we have a setup here on day 1. It got triggered on day 2, and finally on day 3 with that third attempt or last attempt to break higher. It stopped at that 50% Fibonacci level to the pip. By the way, we really like to the pip because that's when the market has really found direction and has a common opinion about what's about to happen next. And see what happens next is the market actually ramps down finally into that 0% level that was the low 2 days before. It is a significant level, so it breaks through, it tests it from the other side. That's a really nice retest. And hurrah, hurrah, we're getting into target at 123.6 for that particular move. So, however, so you could say, like, let's now carry that forward. It has worked so well, that's our quick formula to get rich. I draw the Fibonacci again the next day, right? And the market just goes through that like a knife through butter. Right, so the market goes back again to that 50%. We have some initial reaction, but it goes well above the 78.6, and the market stops us out of that move. Even more frustrating, also here, the market is actually moving nicely into the 1.236 target and 1.8 target. And I think that's a great example for two things. One, please don't expect that every single trade will be a winner. You will have some losers. And please don't be annoyed by the markets just kind of stopping you out and then running into the target. These things will just happen. For you, the one thing you can do is you can execute on a consistent basis. That's really what you need to do. However, what traders will often do at some point, they're so frustrated by the fact that the market kind of just stops them out. And this is the example here. Right? And let me highlight this. The market just moves above this 61.8 Fibonacci level. And traders then see that, get stopped out, and the market moves then down again to this target. And they say, look, I really don't like stops anymore. I will not use any stops. And they start removing stops. And it works once, it works twice, it works 3 times, it works 5 times. But the day will come, and I show you the chart with kind of the really extreme volatility, but that's really kind of credit crisis level volatility. But on a micro level, we have a lot of volatility, especially in the current markets that are driven by news. And there is a good possibility that there is a sustained move and here to the upside that really not just stops you out of your trade, but really has a devastating impact on your trading account. And that again, that's an example where the leverage can break you, because if you have removed your stops and you have a lot of leverage going on, then the market will move very quickly against you, and your hard-earned money that's in your trading account will be gone. And that's the worst thing, because it not only then says that you have lost your trading money, right? Your hard-earned trading money, but you will also lose your emotional money. So emotional capital. And that's really important to understand. If you don't have any confidence in your ability to execute a strategy, if you lose the confidence in your trading strategy, then it will be really hard for you to bounce back. And we've seen it over and over and over again that excessive levels of leverage play a huge role in that. Leverage can really be the devil in your trading if you lack the experience and you move your stops around and you're just very impulsive in your trading. That is a bad thing. By the way, we also see that quite a lot when people try to transition from demo trader to become a live trader, even kind of with small positions. That is very, very hard. Maybe you've been there, you've done that. That you've been very successful in demo, and suddenly you trade micro or mini lots in live in your live trading account. It doesn't work anymore. So what the hell is going on? Why does that happen? Look, what happens is that the psychology changes, because if you completely lose a 500,000 euro demo account, you don't even realize what has happened, because you don't care, right? You kind of emotionally completely detached. But suddenly you're in the money and you are trading your live account with your real money, and it can become really obsessive, even if you just trade like penny or pence sizes with micro lots with really the smallest size possible. When you become immediately sucked into the market in a way where you will look at every pip the market moves up and down, and you will start making foolish decisions. And the, when you talk to traders who've moved then to that next stage, who then moved from, let's say, mini lots to full lots, maybe full lots to 10 lots, at each of these stages, traders find it really, really hard to control their emotions, which you need to. If you want to be successful in trading, you need to focus on flawless execution. But it's very, very hard when you see that high level of leverage and that bigger position size suddenly means that in your trading account, you see the hundreds of euros or thousands of euros really going through with literally every pip moving up and down. So that's a problem with leverage. And if you don't feel comfortable with leverage, start with the smallest position size possible. I can really, really recommend that. I cannot recommend trading only with a demo account, because that for the beginners, of course, just to get a sense where's everything. But if you want to experience the kind of emotional involvement in trading and what's really hard in trading, you need to start with at least a small live account. And then you will very quickly realize, if you want to make a living out of trading, a small trading account with high leverage will not cut it. I've had that over and over again, and I'm quite frustrated by it, that traders come and say, look, I have 500 euros or I have £1,000. I put that into my trading account, and I really have the expectation that that is enough to sustain my lifestyle moving forward. I can tell you from my own trading experience, if you have the need to trade successful in a given time frame, like I need to pay next month's rent. Luckily, I've never been in that situation, right? Or you need money to pay your groceries, right? That will not work, because you will make foolish decisions. You will be in a situation like, if you play poker, it's like almost like being always in, all in, right? Always all in. And at some point it will go wrong. And that's the problem with leverage. But hey, on the other side, without leverage, we would not be able to execute a day trading strategy in a currency pair like euro US dollar, where a broker like Value Trades is really uniquely positioned to give you access to the market, to provide you very low transaction costs, to provide you state-of-the-art trading tools. And again, at the most competitive rates, and you can do it mobile, you can do it on your desktop. That would all not work if there's not a sufficient amount of leverage out there. But the problems always comes in when leverage gets out of hand and gets too big. And that's also something, by the way, that we see a lot with cryptocurrencies. Leverage is quite limited there, and margin requirements are high. Nevertheless, in that particular instance, we have a lot of volatility in the markets. That also counterbalances kind of the whole lack of leverage scenario. So just to sum up this particular point, and then let's have a look at this kind of other view on CFDs and leverage that I've prepared for you. But particular view is that you will need a certain amount of leverage to trade a financial instrument like Euro US dollar, or to trade something like I'm just showing you the DAX index, the German DAX index. But if it's too much, then that is just too risky for your trading account. And it's quite simple, how to calculate that. If you just, my rule of thumb would be, if you calculate what is 3% of your trading account, and you relate that to your trade, and if you're prepared to lose up to 3% in a trade, 3% of your trading account in a trade, then you can just calculate how much margin you need to provide to do the trade. And you're not at risk to suffer from excessive leverage. But there's so many traders out there who are just so keen to be part of the action and put in a trade out of boredom and use the leverage also maybe to recoup previous losses. And I can guarantee you it will work a couple of times, but at some point you will get burned. You will lose your money. Sorry for that rant. But hopefully that gives you, that starts to give you an understanding how margin and how leverage can be a positive thing, and also how leverage can be a challenging thing. But let's not forget that there are some really interesting positive sides. And I really believe that people focus a lot on the negative sides. So on the volatility piece, I wanted to show you that kind of hopefully it's also some consolation to your real stock market portfolio. But we have seen after every single crisis, we have seen a bear market rally. And I think what we've seen after the 2007, 2008 credit crisis is absolutely no exception, right? And if you would update the data with that, maybe that would probably stand out even above the 1921, the 1929 bear rally. That point that I try to make here, again, is a reminder that you should not expect a market to always go up linear in one direction. And if you have a lot of leverage on and the market falls through, then your trade is doomed, and your trading account will suffer. And it just is so hard. If your trading account suffered 60-70% loss or drawdown, that's probably the better way of putting it. If you have a count at that, it is really hard to bounce back. It is absolutely, it is so much more difficult to recoup the losses, to go back to a 50% level in your account, 60, 70, 80, 90%, until you're back at that starting point, right? And a lot of traders really lose faith. And I can only encourage you, especially if you're new to trading, not to put too much leverage on. So here we go on, on my idea and my suggestion I want to give you on how to connect maybe your real stock market portfolio with a CFD, and how to benefit from the leverage that is available. So I'm just hypothesizing, and being a German that lives in Britain, in London, to be precise, I still picked some German stocks for you. I picked BMW, I picked ThyssenKrupp, I picked, as we call it in Germany, Bayer. I think internationally we say Bayer, and Siemens. And I'm saying, I'm hypothesizing, and that's what I have in this what I'm showing you in this box in the top. I'm hypothesizing that you have a stock portfolio that in real terms value has 10,000 euro worth of BMW stocks, 5,000 Siemens stocks, 8,000 ThyssenKrupp stocks, and 15,000 Bayer stocks. Right, that if you add that up, that is 38,000 euros worth of your investment in real stocks. And with stocks, as you know, you don't care about volatility or anything too much, because there is no margin requirement, there's zero leverage, and that's fine. The one thing I looked at, and I just looked at a kind of a standard, kind of a broker, a large broker in Germany that is where you're able to buy some stocks just to get a sense of transaction costs. And what seems to be quite common is something like 0.25% as a commission for the trade. So if you want to buy that portfolio, that sets you back around 95 euros for transaction costs, and hey, excuse me, hey, off you go. You suddenly have a portfolio of 38,000 euros. But let's now fast forward to a point where you anticipate a lot of risk in the market. That could be, for example, we had Brexit, right? I can vividly remember the Brexit evening. We had the Trump election. We had people tend to forget that when Trump was elected in the middle of a kind of election night, when the markets opened, we had limit down. We had 7-8% down in the markets. So there's so much uncertainty. People didn't really know what that means, and markets went really jittery and lost a lot. So these are the moments where we anticipate a lot of volatility in the market. And as I've shown you in my introductions, a lot of volatility typically means it goes down, it goes up, it goes down. So what can you do if you have your wonderful 38,000 euro portfolio? You can sell your stock, right? But that's a problem. That's a problem for a couple of reasons. One, you lose your transaction costs, right? And they're gone, and they're not coming back. If you want to purchase the stock again after that significant news event, maybe you need to pay another 95. And what typically happens is that the price has moved and you're losing a couple of basis points in performance there as well. So suddenly you look into a scenario where it's quite likely that you're going to lose a couple of €100, which is not nice, right? In a portfolio of 38,000 euro. So that's a problem. So that's a question, and also maybe you, depending on the timing, you could lose your right to get the dividend, right? That could be also a problem, and there are other reasons why this could be tricky. So maybe you want to hold on to your stocks, because what real experts in capital markets will tell you is that, yes, you should, from every now and then, you should maybe have a think about rebalancing your portfolio, but holding on to a stock portfolio is typically the right thing, especially if you invested in blue chips like the ones I've picked here. But again, this is no investment advice, just an example. But I think I got the point across. This is now our hypothetical portfolio. So what can we do? And well, one thing you could do is you could try to find a broker that kind of offers you financial instruments where you can speculate on the individual stock on falling prices in the market, right? And not just these products exist. But the problem here is, I think it's not a very efficient use of your capital, especially the margin requirements to open short trades that mimic your portfolio exactly. It's quite expensive, actually, especially from a margin point of view. Yes, you get the margin back, but you need to factor all that in, and you need to kind of provide the margin, and the markets can move against you. That could be a bit of a problem. It could be quite costly. So again, what I'm suggesting here is, so you have 10,000 BMW in your real stock portfolio. I'm suggesting there could be an opportunity when you think of the perfect hedge scenario that you go short a trading position 10,000 BMW, and boom, you completely eliminated the risk of BMW going up and down, because either the value goes up and your real stock portfolio will then be more valuable, or it goes down, and then on the other side that short trade delivers a return. But as I said, not a very smart idea, because you need excessive margin in the thousands to cover that risk, and it also adds more transaction costs. But here's a clever idea on how to use, let's say, a CFD on a DAX 30 in this case, and how to benefit from the leverage that CFD brings with itself, and still minimizing the risk in your portfolio. So you could also argue, and that's the important point, you could argue that BMW, Siemens, ThyssenKrupp, Bayer, they all come from different sectors. I think I didn't pick something from financial services, but we have an interesting mix of automotive companies, an engineering company, a steel manufacturer, and a pharmaceutical company. So very different sectors that not always correlate. That means that you could start looking for what pro traders call a proxy. Is there something that has a similar risk profile to these individual stocks in the portfolio, and you could say, yeah, there is something. Actually, this is a fair representation of the German DAX, the German index. So if I would want to minimize news-related risk ahead of a, let's use the Trump example again, ahead of a potential Trump election, I could say to minimize the risk in my portfolio, I go to Value Trades, open an account, put some money in, and in order to secure my 38,000 euro real money portfolio, real stock portfolio, I open a CFD short on the German DAX that represents 38,000, and only because there is leverage out there. That's the reason why you don't have to put 38,000 forward, but only a fraction of that. Maybe you only have to put in a couple of percent, right? Just this is an example. The number could be different, but maybe you only have to put forward a couple of percent. So let's say 1,000, maybe it's a little bit more. But the point is, with a margin of around 1,000, you can hedge this position. You can secure it. While the hedge will not be perfect, if the market goes down, your short position on the index will generate a profit. If the market goes up, your real portfolio will go up in value. So you can sustain these uncertain moments, and the use of a CFD and the fact that there's a lot of leverage behind a CFD is actually quite beneficial. And you can sleep well because while the hedge is not perfect, but the hedge is very, very closely correlated and strong enough to minimize your risk. Let me just also with some simple lines just show you what I mean. So if you are, with the blue line is supposed to represent your real stock market portfolio. So the idea is it could go down, can go up, you don't know, but it could go down driven by this news risk. And then with that perfect hedge, if you invest in kind of opposite positions to the ones that you have in your actual portfolio, then that risk will always be taken out completely, right? And will always, there's no risk anymore. All you have is transaction cost. And that can be quite helpful also in moments, maybe just also to tell you that how professional traders look at that. People who run big pension funds and professional traders also look at volatility breaks. If they sense there's too much volatility in the market and they want to secure their portfolio, they start putting these things in. Again, with referring to the peak volatility moments, they say like, oh, I want to be ensured that if the market completely falls through and if we have another 2007, 1987, 1929 moment, I have some adequate protection in place for that. It could even mean that kind of the trade goes wrong, but it doesn't go wrong in a way that you lose a lot of money. It just goes wrong. It's almost like an insurance policy, right? So that's quite clever. So this is the perfect hedge, but as I said initially, that perfect hedge is quite expensive from a margin point of view, and you need to make sure that the broker provides every single financial instrument. And quite frankly, I think that's really not the point. We should be a bit smarter than just going for finding a broker that offers hundreds of thousands of stocks. I think what's the point? Seriously, right? What you want to do is you want to find a proxy, something that mimics your portfolio, and with a very efficient use of your capital through opening a short trade that goes against your kind of real stock portfolio. In this example, the DAX 30, you will be able to at least partially offset the risk in your portfolio. Why partially? Again, let me make that point. If you have nicely diversified portfolio, then it's nothing else than a representation of the underlying index, right, or the composite that these stocks are a part of, right? So that's something that hopefully gives you an idea how professionals also look at CFDs. That's actually when you look at the origins of CFDs. This is where the whole thing came from, right? It came basically, the whole thing came from hedge funds in Mayfair in London, expressing an interest. They wanted to have a very flexible financial instrument that they could use for hedging purposes, also to get in and out of the market in a more efficient and quick manner. you know, when you buy a stock, it can take a while until you get a quote. It can take a while until you get an execution. Even worse, if you are in a pension pot, right? It can take days, it can take weeks until a trade is finally executed. So that's why people who have these kind of problems also think about to use the leverage in a positive way, right? In a very positive way. And as it is hedged, and that's what kind of what hedging brings with it. It is not the leverage is not a problem. The leverage here is really an advantage because it's a very efficient use of your capital, right? One thing not to forget is obviously the trade can also move against you. You also need to make sure that you don't just put the margin in your trading account, but also you need to put the amount of money in there that is basically the amount that represents your insurance policy. But I think what I like about the way of thinking about CFDs in that particular fashion is that you're very calm, you analyze your risk, right, and you do everything to protect your capital, and that's getting me back to the starting point. So let's go back to the charts and let's have a look at let's have a look at a couple of really important financial instruments and also do a bit of technical analysis, because I know that you guys also appreciate that we do a bit of a review of some of the financial instruments. Because what we have right now here, let me just make sure that yeah, so this is correct. So we have the DAX here, and I think the DAX is a good example where you can see that we are now at a really interesting support level, and we have broken through other trend lines already. See, so that's a very, very interesting zone we are in right now. So to the downside, we are being supported by a couple of things. Let me just also close this to make it a bit cleaner for you. To the downside, we had these levels that have been resistance previously, and we had this move down here to the 8,600 level that shocked a lot of traders. This became resistance again. It got broken when it got tested as support, and to the point it got tested as support. The markets have moved up again. Now the markets put in could be a bit of a head and shoulders pattern until here. Kind of the markets move back down to this line that was tested at previously as support and resistance. Again, it's important. Yeah, and the market is now bouncing up and most recently down again. So we are now in this situation where we can say that we have significant support here. Oh, sorry, I need to move this box down. We have significant support here at this 11,850 level. Let me just round it up to the upside. The 13,000 level roughly is a really important one. And obviously, we're also going to have a look at a level in the middle, like the 12,385 that I've drawn here. If the market, and that's important also again from a kind of volatility leverage point of view, if the market manages to break below this 11,850 level, then there is indeed a lot of space to the downside. And again, if you are in a big position and you have a lot of leverage going on, that can absolutely cause a problem, right? That can really cause a problem, because there's so much space to the downside where you could easily, if you could kind of almost eyeball it, we have levels that take us all the way down to 10,000, right? And there's a huge gap here on the left. Well, to be fair, it has been closed, but the markets now, I think the next big level that they are telegraphing us, the market would be in that 10,000 area. So I'll keep a close eye on this. And let me just make it very clear again. If you are in a trade and you say your hypothesis is that this level holds, don't wait for the market just to go against you hundreds of points, right? Because that's where the leverage becomes a real problem. That's where any account really loses a lot of its value very quickly. And I've seen it over and over again that people start with a trading account and let me just give you an example, 10,000, right? We started with a trading account 10,000, we have a couple of trades, it goes in the right direction, 10,000, 10,050, 10,100, 10,200, 10,300. Suddenly they increase the position size, and coming back to the point I made earlier, increasing the position size changes everything. They change their behavior, and suddenly they incur some big losses. First, it's just a couple of hundreds, taking them down to 10,000 again, 9,500, 9,300, 8,800. Damn it, what happened this week? Why was this week so bad? I will get it back next week. Next week, what they do is they again increase position size, and suddenly maybe the first trade worked, and they said, all right, I'm on track again. But what we really do is they introduce a lot of risk and they abuse leverage, right? But when really happens is when suddenly the account moves back from 8,800 in one step to 6,900. Oh, I started with 10,000, now I'm 6,900. Crap, what has happened? All right, I will just, have trust in myself, keep a high level of risk and leverage. And boom, at the end of a week, maybe it's 4,800. And then it's 4,100 the following week. And then what I see over and over again, you've lost 60% in your account. And when people say like, oh, I go all in. And then they increase their risk because they know when the account is down to a couple of hundreds, they can't because it's just not enough in the account. And then they ramp up leverage and they ramp up position size to the absolute maximum, and the count fluctuates like crazy from 4,500 or 5,800, 6,000 down to 3,000, and then in a flash up to 4,500 again. And then it typically goes wrong. And what I see is the account only has like a couple of hundred, maybe 200 left. And then the trader asks him or herself, what the hell has happened? Why have I done this, right? And that's something that I've seen happening quite a lot over time frames of like 2 months or so, where people then really in the end, when the account was already down 50, 60%, started to abuse leverage and started to accelerate the destruction of their hard-earned trading capital. And that's always a shame. It's such a shame. If you ever find yourself in the situation you've lost 50% of your account and you just don't know what you're doing, find an opportunity to disconnect yourself from the markets first. Try to find a way to either kind of hedge your risk or minimize risk or close the trades. Find a proper exit strategy. Don't just click on close. There's normally a better way. Once you've done that, try to step back and get some perspective. What has just happened? Why has it happened? Because that will be really important for you to start a journey that enables you to become a better trader. And maybe you call up value traders and say like, look guys, I think I've had too much leverage. I think I for the time now, I don't think I can handle it. Can you please reduce my leverage to another level? I think that's a possibility, right? And you can reward yourself again then with more leverage and bigger position sizes if you've been consistently able to execute well. And that's another point, and hopefully a pro tip that you find useful. If you have you should have a trading journal. If you look at the performance of your trading strategy at the end of a month, you maybe have executed well and you've made 3, 4, 5%. Well done, great month. If you had that experience, reward yourself with a slightly bigger position size. Maybe increase your position size by 10 or 15%. Don't tenfold it, 10, 15%. When you have another good month, reward yourself with another 20% bigger position sizes. So you will adjust yourself to the higher levels of risk or reward yourself with a bit more leverage. You will adjust yourself to that higher level of risk and you will make better decisions because you're more comfortable with the numbers. And the same applies the other way around. If you struggle, if you had a couple of bad weeks, maybe a bad month or two, decrease your position size. Find your emotional balance again, right? And kind of earn a right again to go back to a higher level of leverage. But don't try to just then you're really vulnerable and you're at your weakest, don't then try to maximize leverage and position size, because this is a 100% sure disaster recipe for disaster. I've seen it so many times, and I just recently had a trader who went through that experience, and I find it so frustrating. And that's what differentiates traders who have really made progress in their journey to become a mature, stable, successful trader. And successful doesn't mean that every month is a success, right? Versus very volatile, shooting from the hip, going quick in and out of the markets, because that's something that for sure will push you out of the market very quickly, because your trading account will be empty. Let's have a look at the indies, the euro US dollar again. So first, I showed you the DAX 30, admittedly, because there is this underlying assumption that stocks go up over a period of time. That's why the DAX is pointing up, but please don't get fooled. When an index moves in the other direction, that can be quite violent. What many traders like, and I agree with that, is something like euro US dollar. You have a high level of liquidity, you have a lot of participation, you have sufficient leverage to trade this market. I mean, euro US dollar is a market that I personally really like and really enjoy trading. You have it behaves in a very technical manner, because there's so many trading participants, because even if you have billions in your account, you will not be able to move that market in your direction. And I confidently say that again, if you have your billions in your trading account, you will not be able to move the market. Probably you will not be able to find a broker who can execute that trade as well. But even if you could, the market is so deep and so liquid that would probably not be a possibility. So that's good for us, because we can apply all sorts of things like technical analysis, and we need a certain level of leverage there, because otherwise we would not be able to execute any trading strategy. And the point I made to you by showing you, again, it's not a trading recommendation, but I was showing you a standard setup, right? And there's more to a strategy than just a setup. I showed you the previous day Fibonacci setup. Previous day, we go from the high to the low. Market moves back into this 50% back region. Doesn't really exceed the 61.8. It goes into target. And then the next day, after it went into target, this trade doesn't work anymore. And then the next trade, this looks like actually, let's have a look at today. All right, today actually we are again on the winning side, because the market again moved into the 50% back at 61.8, held, and right now this hypothetical trading strategy, the trade is still open. But again, nobody knows what's going to happen, right? And if you start increasing your leverage, if you start to excessively increase your position size, and worst thing of all, if you start moving your stops, right, then there is a possibility that you'll be kicked out of a market very quickly, because your trading capital is gone. So if you're new to trading, maybe you want to take the simple setup that I just shown you, and start just to use that. And that would be my offer to you as we kind of conclude the webinar for today. You start to just think about disciplined execution in the market with a decent position size of not more than 3% of your trading capital, with a decent amount of leverage that you put in there, which is not in the thousands, right? And a good broker shouldn't be able to offer you that. So I know for a fact that Value Trades would never do that. And you just focus on the execution of your trading strategy. Thereby, you shift the focus away from, the next trade, and does it go up and down, and can I move my stop? No, that's not important. It's all about disciplined execution. And then look back after 50 trades, after 100 trades, have you executed every single trade in line with your expectations, in line with the strategy? And if the answer is really yes to everything, and I will guarantee you will probably not on every single trade say yes, but you should get to that point where you say yes. And then I can virtually guarantee you that you will see an improvement in your trading, because you will be able to execute on a much more stable level. And a lot of traders, I've done that in the past, they actually even have seen an improvement in their actual performance. Why? Because they stopped messing around with things like leverage, they stopped messing around with things like stops, they stopped messing around with going into the market with too much risk. So sorry, I take a bit out of I take some of the excitement out of a trade and out of trading, not all of it, but I want you to be able to trade another day. And I want to avoid that you end up in a scenario that the leverage actually kind of has broken your trading. And the final point is, really the very final point is also the scenario that I've shown you around using CFDs and a proxy like the DAX index. It also works with FTSE and also works with S&P 500 and others. Find maybe a way to replicate your real stock portfolio. And if there is a moment of heightened volatility, and with Trump, you never know, in Syria, North Korea, and so forth. And if you want to hedge and eliminate your risk or minimize risk for a specific period of time, I think CFDs are a fantastic tool to do that. And that's actually why they got invented at some point. So I hope you found the webinar today interesting. I hope you found my approach also a little bit different. The connection between real stocks and CFDs. I haven't seen that anywhere else. We've done a lot of videos on indicators, so I can also encourage you to have a look at the video section on the VeloTrade's website. We are doing more of them in June. I look forward to that, and we're also working on new blog posts and new insights, and it's really exciting working with the guys at VeloTrades, and I look forward also to the webinars that we have coming up in the next couple of months. I think the next one is with Paul Wallace. Sorry for kind of keeping you so long, but let's see, do we have Paul here? See, trade better with stop losses and learn to take profits. I think that's a really good next step from what we discussed today on what we discussed today on leverage. Connect that with your ability to take stop losses and learn to take profits in a disciplined way. So have a look at that. Watch on an on-demand Forex trading webinar. Paul is a wonderful, very professional trader, a good friend of mine, and we look forward to conducting many more webinars with you guys in the future. So thank you very much for your time. I hope you have a nice evening, and all the best for your trading. Thank you. Yeah, I just saw that's a recording. Sorry, got so excited. All right, thank you. Have a nice evening.